Hi there, welcome to this channel from wherever you are. Today we'll be looking at Oracle fixed asset. And specifically, we'll be looking at asset revaluation. Under the asset revaluation, there's some few things we need to check. And one of it is to understand what is fixed assets for a quick review or understanding of what is fixed asset. And fixed asset is a long-term company item or thing. And this long-term item, they have useful life which goes beyond 1 year. And for instance, we have land, we have equipment, we have furniture, we have buildings. So what is fixed asset revaluation? Under fixed asset revaluation is a concept of giving an asset a new value that is different from what is currently in the company's book of accounts. In other words, we call it net book value or NBV. It's also good to note that asset revaluation can be up or down. Why fixed asset revaluation is done? So one of it is that the market value changes. So the company adjustment is required to reflect the current market value. Secondly, compliance. In IFRS accounting standards, there is allowance or requirement for transparency. So this is done to comply with IFRS accounting standards. The third one is financial accuracy. For the company where need to improve their accuracy, they will need to do asset revaluation so that they can reflect the asset book value. The fourth one is the improved borrowing power. With a higher asset base, a company can improve their balance sheet strength, and this will make them have more power of borrowing. Next, we'll look at what changes when an asset is valued or revalued. One is the asset book value. So for instance, if the appraisal value is greater than book value, it gives a revaluation surplus, which is added to equity, sometimes through revaluation reserve account. If appraisal value is greater than the book value, and there was a prior revaluation loss, the revaluation income is posted in P&L income account as a reflection of an income. If appraisal value is less than book value, it gives a revaluation loss posted in P&L expense account. We can be able to look at this deeper and we understand the accounting entries. So we'll start with if the appraisal is greater than the net book value, or rather, the valuation is surplus. So in this case, we have an asset whereby the original cost was 10 million, and the net book value is 7 million. And then the appraisal was done, and it got to be 12 million. So there is an increase in the appraisal. So what happens is that when it comes to the accounting, we will debit the accumulated depreciation. And why are we debiting? This is to light it off because depreciation will be calculated on the new asset value, which is the 12 million. Then we'll debit the asset account with 5 million. And why? This is to increase or add the current asset value in the balance sheet. Third, there will be crediting of revaluation reserve account with 5 million. And this is to comply with IFRS, which is directing or which has directs that the increase of equity is always a debit entry. So in another case, whereby we will look at if the appraisal is less than net book value, which is a revaluation loss. In this case, our original asset cost was 10 million. The net book value is 7 million. And the appraiser has appraised or has revalued it to 5 million, which is a decrease. The accounting entry will be, there will be the debit of the accumulated depreciation amount, whereby it is obvious to write it off because of the depreciation will be calculated on the new value, on the new asset value. Then there will be asset account, which will be credited. And this, it will be credited with the depreciation amount that has already been done, and then the loss on revaluation. So the decrease or the reason for crediting the asset account is to decrease or reduce the current asset value in balance sheet to 5 million. Then there is debiting of the expense account or impairment loss with 2 million. And the reason is why a loss a loss in value that is treated as an expense. If we proceed, we can check on what challenges or what changes when an asset is revalued. The second item that changes when an asset is revalued is depreciation. So depreciation is calculated based on the new value and the remaining useful life. For instance, or for example, a building bought for 10 million USD depreciates to 7 million USD. A valuer reports market value as 12 million. A new calling amount is 12 million and revaluation surplus is 12 million minus 7 million, which is 5 million. The surplus goes to equity and a revaluation surplus account. Future depreciation is based on 12 million and not 7 million. Apologies for saying that building bought for 10 million. This is depreciation, not appraisal. Appraisal is of the amount of 5 million, increase on the 7 million. I hope this one is clear. Next, let's look at what revaluation is not. Revaluation is not a cash transaction. It does not improve profit directly, and also it does not occur frequently. It must be justified and well documented. Finally, we just look on a high level how asset revaluation is done in Oracle Financials. So whether it's Oracle EBS or Oracle Cloud Financials, Oracle gives two ways to revalue assets: by entering a new fair value or by applying a revaluation factor across multiple assets. I hope this video has given you some insight on the approach that you should take when it comes to asset revaluation. Thank you very much, and I kindly request you to subscribe and like so that the video can help as many people as it just has helped you. Thank you.